In this video, we're going to discuss cost-based transfer prices. So let's say we've got a company called ABC Automotive, and they produce cars, and they have multiple divisions. They have a battery division that manufactures batteries, and those batteries could be sold to some outside firm, or they could be transferred to the automotive division within the same company that produces the cars, right? Obviously, you need a battery for a car, so the automotive division could get the batteries from the battery division. And then the question is, what is the price that the battery division should be allowed to charge the automotive division for the batteries? So when we use cost-based transfer pricing, it actually could mean a number of things. So one price that could be charged by the battery division would be the variable cost. So let's say the variable cost to produce a battery is $55. So every time a battery is produced, it costs $55. So then that would be the price that the automotive division would pay if they were willing to go along with it. They would pay the variable cost of $55. But there also could be that the company uses full cost transfer pricing. Full costs include not just variable costs, but fixed costs. So it's variable costs and fixed costs. This is generally not recommended. I'll go into more detail about that later. But we have got variable costs and fixed costs. So let's say that they were $70. Let's say there was $55 per unit of variable costs, and then 15 of fixed cost per unit. So the total full cost per unit was $70. Then the automotive division would have to pay $70. Or you could just have a situation where you have what's called cost plus, which is just there's some type of cost format, but then the selling division marks it up 10% or 15% or 20%. A lot of government contracts are on a cost plus basis. That doesn't really have to do with transfer pricing, but it's the same kind of idea where basically the selling division is going to charge their cost, and then there's going to be some kind of percentage markup for like a profit. Okay, so let's talk about the pros and cons of these different approaches. So it's actually very common to use some kind of cost-based transfer price, and the reasons are that it's very easily to calculate. Remember, with market-based transfer price, if there's no external firm or market for the item that the battery division is selling, maybe it's specific, only this division would ever want that item, then it's hard to figure out the market price, but we can always figure out the cost. We can always figure out from the battery division what it actually costs to produce this. And it's easy for people to understand. People get it. Oh, okay, the variable cost was $55 a unit. Okay, I understand that. The disadvantages, and there are several, is that one is when there's excess capacity. And when I say excess capacity, I mean that the battery division can't fully sell all the batteries it has to outside entities. It would have some left over if the automotive division didn't buy any. Let's say it had 100,000 batteries, it wouldn't be able to sell all 100,000 to outside entities. There'd be some leftover. So we call that excess capacity or idle capacity. When there's excess capacity, the use of full cost could result in poor decisions. Okay, so if we say, for example, again, that full cost is $70 a unit. Okay, and let's say that so we've got excess capacity, there's plenty of batteries here to go around, and there's an outside entity that is willing to sell a battery to the automotive division for $60. For $60 a battery. So the buying division is not going to pay the full cost, the $70 a battery to the battery division. They're going to go to the outside entity and pay $60. Why is this a problem? Because if the variable cost per battery was $55 and now we're sitting here, we could have paid, it really only cost the battery division $55 to make the battery, and they have extra batteries, there's excess capacity, so really the price could go as low as $55, and this division is no worse off and the whole company is better off. Wouldn't it be better if the company, if the automotive division is getting it for $55 instead of $60? I mean, we're actually paying more to go outside the firm when we have excess capacity. This division would not be harmed. So that's why full cost is really, really problematic. So it can lead to suboptimal decisions. Another issue is, so let's just assume let's say we're using the variable cost. Let's leave aside the issues with full cost. Even if we're just using variable cost and it's $55, And so then the battery division isn't going to recognize any kind of a profit. They're not going to make any profit. So there's going to be no profit for the battery division unless there's some kind of cost plus where there's a markup of 10% or something. But if it's just straight up variable cost, then they cost them $55, the battery division, to produce the battery. And then they sell it for $55. So they have no profit. And because they have no profit, how do we evaluate the profitability of that division? That division has just become a cost center, which isn't necessarily a bad thing, but we'll talk about that more later. So now, another thing to think about is once we go to some kind of cost-based system, now there's really not much incentive for the selling division to be controlling or to be trying to reduce their costs or keep them low. Think about it. If you just produce the battery for $55 and then you sell it for $55 and you have zero profit, that's different. If you had made it, let's say, for example, you could charge $80 and it cost you $55 to make it, then you're getting a $25 profit every battery. Now, let's say that you could somehow reduce your cost. You could improve and get better with your cost management, and you could get to where it's $50 variable cost. Now you've got $30 of profit per battery, and your division is looking better. Your division is looking more profitable. The manager might get promoted and so forth. But if we say no, we can't charge $80 per battery. We just always have to do the cost. Well, if it's $55 is the cost and you sell it for $55, there's zero profit. Okay, and then if you get the cost down to $50 and you sell it for $50 because you're restricted to only sell it for a cost, you have zero profit. So you took the cost, let's say hypothetically, down from $55 to $50, but either way you have no profit because you're still a cost center. Now you could say, well, still the top management, corporate management, could look and say, oh, are you doing a good job, reducing your costs and stuff? But there's clearly more of an incentive to control the costs when that selling division is treated as a profit center, and we can clearly evaluate their profit because then they want to maximize their profit. So one way they can do that is by controlling the costs and keeping them as low as possible.